Welcome everybody, glad you're here. And today I think the teaching topic today a little bit, we'll talk on Iron Condors a little bit. And we'll start out looking at a price chart and we'll jump in. Somebody asked, will I be speaking on weeklies? No, but it's the same principle. I am finishing a class on weeklies this week, and it'll be available in recording probably by the end of this week, and we covered Iron Condors in that. But today, I think I picked a May expiration. So let's jump in here. All right, first of all, when we look at a price chart, let's look at a price chart here. This is a price chart of SPX. Right now, SPX, as we speak, is in this, SPX is around 2065 as we speak. And let's see, what have we done here? If you look at the market, we had a low, a recent low of 1810, Feb 11, right? So a low of 1810 on Feb 11. And today, which is, what are we today? April 4th, around 2065, 2077, let's call it, 2065. So we're basically up, you ready for this? 255 points in the SPX in 7.5 weeks. How many of you are ready to drink the Kool-Aid and think we'll be up another 255 points over the next 7.5 weeks? How many of you would like to drink the Kool-Aid and believe that we're going to be up 255 points over the next 7.5 weeks? All right. Anybody? Anybody want to drink the Kool-Aid? Well, again, so let's look at this. So we're up approximately 14%. Right? Most of you, if I said to you, hey, would you be happy if SPX was up 14% over the year? You'd say, Dan, you kidding me? My retirement stuff, 14% for a year? That's phenomenal. We're up 14% in 7.5 weeks, right? The other bit of perspective is, right, so we're up, since Feb 11, 7.5 weeks, that low of 1810, we're basically up 14%, 7.5 weeks. The high was in May of 2015, 2134, and we're only about 65, 60, 67 points away from there. We're only up 2%. If we went up 2%, we'd hit there. So, first thing I want to be clear is, I don't know which way the market's going next. And I want to hurt your feelings, but don't be hurt, please. You don't either, right? You can guess, just like me, which way the market's going over the next couple of weeks, right? And we like to guess, right? We guess on who's going to win opening day for our favorite baseball team. We say who's going to win tonight, and we all have strong opinions, right, in the NCAA championship. Did you ever notice all these experts on sporting events, and they all give their opinion, but a week later, no one knows what they said or forgets what they said, and they're probably half right, half wrong. It's just, sometimes you remember the bold predictions, but the key is none of us know over the next 2 or 3 weeks which way the market's going. All right? Sure, the contrarian in me, yeah, we're going to back off, but I don't don't know when or whatever, but the bigger picture is, how would I want to structure an Iron Condor, right? SPX is 2065, the VIX is 14, right? And what's the lowest the VIX has been since you guys were in grammar school? What's the lowest the VIX has been since you guys were in grammar school, right? What do you think? What's the lowest the VIX has been since you guys, 9, 10? So okay, if we go back to when Rick Lee and Ralph and all these guys were in grammar school and VIX is 10, how many points more, right? Just like I said, we're only 60 points off the high of SPX. How many points are we away from 10 in the VIX? 4, right? And that's like the lowest it's been. So if I want to structure a trade here in an Iron Condor, right? How do you think I want to structure a trade? It's a short Vega trade. And what does that mean, short Vega? It means that if the volatility goes up, which it does on the downside, we'll get hurt some. Do I want to structure a trade at this level? Now let me be clear here. I didn't say a directional trade. You with me? I'm not saying directional. My question is, if you were structuring a trade here and pretending it's pretty close to non-directional, right? I'm not getting directional. But would you want more room before you get in trouble on the upside or downside? If you're starting a trade with risk in both directions, would you rather structure it at this point with more risk, or let's put it this way, would you rather structure it that you have more room before you get in trouble on the downside or the upside? Right? I'd want to structure it more room on the downside. Now, Rick says, I do not do Iron Condors and SPX and VIX if it's less than 16. I would do Iron Condors and VIX if it was 15, 14, 13, 12, 11, 10. Get ready. 9, 8, 7. Don't do it, Dan. 6, 5. Don't do it. 4. So in other words, I would do Iron Condors whether the VIX was, whatever the level is, right? But the key is, how do you set it up, right? There's laws in the state of Illinois. Well, I'm in Greenville, South Carolina for the winter, but there's laws, recent laws in the state of Greenville, South Carolina, that I can structure my Iron Condor any way I'd like to, right? I can structure it any way I want. But the point is, if I'm playing the Iron Condor game, here's the most important thing in my opinion to being successful at Iron Condors. We'll go over an example of what I would do today. Number one is, it's a high probability trade, so number one, play every month. Regardless of my stinking opinion, I don't care about your opinion on the market, I don't care about my opinion on the market, right? Regardless of our opinion, if I'm playing a probability trade, right, I've got to play, right? I've got to play. I don't care, right? Now, I'm aware, right, and I'm going to structure my trade a little differently at 2065 than I am if it was, anyway, let me show you how I might structure a trade. There's different ways to do it. But again, I'm not going down the road of directional, because here's the key. And I understand what you're saying, but if my job is, let's say in Iron Condors, I'm doing it to make $1,000 a month, or $5,000 a month, or $10,000 a month, and I have this, and I have, because that's what I teach students. I don't care what capital level you're at, depending on whether you're beginning or more experienced, what's your target goal? What are you trying to make per month? Well, let me ask you a question. Can you make money if you don't trade? Yes or no? Can you make money if you don't trade? That's a deep question. No. So let me talk about how I might structure an Iron Condor in this market. There's many ways to do it. But again, I'm not going down the road of directional, right? Okay, so we're falling a little bit, right? We're down 9 points. It looked like the market was kind of stubborn to go down today. But so what I'm going to look at, I'm just taking one type of Iron Condor today, right? I could spend the next 17 years talking about Iron Condors, right? Different variations, different things. I don't know about 17 years. How about 17 weeks? 17 weeks I could, but I don't have 17 weeks right now to do it. So I'll just talk about one methodology. So first of all, let's get into it. So first of all, the vehicle. If I'm doing Iron Condors, in our community we prefer SPX and we prefer run. Can you do question? Somebody said, is SPX better than SPY for Iron Condors? SPX isn't better than SPY. SPY isn't better than SPX. The thing is, there's pluses and minuses to both. What are the pluses of SPX versus SPY? The pluses of SPX versus SPY is it's going to be better tax advantages. Another plus of SPX over SPY is less commissions because you'll trade less contracts because SPX is 10 times the size of SPY. And I mean, I like SPX better. I've never really traded much SPY, but SPY is fine. I think if you're starting out and you want to keep your trades a couple $100 or less, you know, SPY is a decent alternative. All right, so let's jump in here. So with SPX at 2063.84, let's just call it 2065. For this particular Iron Condor today, again, remember what I said. I want to structure my trades so that I have less risk on the, or more room on the downside and then the upside. All right, so let's go through this. So we're at 20, I'm using 2065 in the SPX, and the VIX is very low. The VIX is, and don't say it, 14. So what I'm going to do today, I'm going to use something called a high probability condor. A term I use to designate trades are about 80% probability at expiration. So what I'm going to do is I'm going to sell on the call side. First of all, I'm going to be in the May expiration. The May expiration is about 45 days away. Again, I'm going over an example of a longer, of 45 days out. And I'm going to sell the what am I going to sell? I'm going to sell the 2150 calls. I'm going to buy the 2160 calls. I'm going to sell the 1910 puts and I'm going to buy the 1900 puts. And it's trading right now at about $1.90 credit. Okay? And so this is your graph at expiration. And your short strikes is going to be your upside, 2160. And your downside is going to be 1910. And right now we're trading around 2065-ish. We're about right here. See that? Right? The short, so I basically, when I was doing this, I was looking to get the delta of my short call and the delta of my short put around 11. Right? And with the, so I took the same delta for the call and the put, but that gave me with, so I said 2065, right? My 2150 calls are how many points out of the money? How many points out of the money would be my short calls? How many points out of the money would be my short calls? I'm sorry, 2150. I'm sorry. Thank you. So my short calls are 2150. How many points out of the money are the 2150s? How many points out of the money from the current price, let's use 2065, is 2150? The answer is 85 points. That's about an 11 delta. How about the puts? The 1910 puts, how many points are those out of the money? How many points are they out of the money? 155. Okay? So do you have more room on the downside or the upside? More room on the downside or the upside? Downside. Now, you look at the position Greeks, the deltas are about 16 deltas short. And this is a 10 contract trade. The deltas are 16 contracts short. The theta is positive 47. And the short vega is 383. So let me ask you a question. Is this a directional trade, in your opinion? Is this a directional trade, in your opinion? What do you mean somewhat? Somebody said somewhat. Eric said slightly. Someone else said somewhat. What do you mean? Tell me what you mean by that. Tell me what you mean. Tell me what you mean. So John says it's slightly bearish. Joe says negative delta. Brian says minus 17 delta. Well, let me ask you a question. If I went over to the CBOE right now and waited outside the CBOE doors at 3:15 or whatever when they're done trading, and I stopped every market maker coming out, I said, sir, I'm doing a survey, I'm doing a poll. I'd like to ask you a question. If you had a position that's short about 16 deltas and short 390 vega, sir, am I leaning neutral, bullish, or bearish? What do you think those market makers would tell me? Anybody know? Anybody? Well, they might tell me that, hey, at the very least, they'd say, I'm neutral, but neutral to maybe a little bullish. Because a lot of you were saying, Dan, you don't get it. You don't get it. Dan, don't you see? It's negative deltas. What's wrong with that type of thinking? What's wrong with the type of thinking? Eric says I don't, or Chuck says I don't see. You guys are seeing my Thinkorswim, is that correct? You guys are seeing my thinker swim. All right, here's the answer. You ready? If we're going to answer this question, we have to answer a fundamental question. For Brian and the rest of you, what's going on? How does your mind define neutrality? In other words, how is your mind when Brian or the rest of you or some of you who said negative when you are in terms of this is a bearish position, how are you processing that this is bearish? What are you looking at? What Greek are you looking at? So in your mind, the way you say a trade is bearish or bullish is by looking at the delta, right? That's price risk. Agree? My question to you is that reality or Disney World? In other words, if your definition or concept of neutrality on a trade is based on price risk only, looking at delta, that means you're not looking at all at volatility. In other words, when market makers in the pit or traders, professional traders, are looking at a position, they're looking at, well, what are your two risks? Well, if I'm doing a 45-day Iron Condor, I have two major risks, right? And what are your risks? My risks are price and volatility. Price and volatility. We say it again in Spanish. Price and volatility. So if I'm only looking at delta, right? If volatility didn't exist, you're 100% correct, right? This is a bearish position. If volatility doesn't exist, this is a bearish position. Why? Because I'm short deltas. If I'm short 17 deltas, we go down $1, I make $17. I go down $2, I make 34. But the thing is, we have this thing called volatility risk. So really, when I look at this trade, am I bearish or bullish? The answer is neither. It's pretty neutral to me, right? It's really a little bit, in Dan Sheridan's opinion, it's a little, it seems a little bit bullish to me. Hey, Dan, why does it seem a little bit bullish to you? Because the VIX is, let me say this again in Somalian and maybe a little bit of German. The VIX is 14. Let me say it again. The VIX is 14, right? And what does that mean? It means if we go down 20 points in the SPX, right, what do you think the volatility will do? It will go up, right? And our Vega is about 400. So if the volatility goes up, for every point it goes up, it could lose about $400. So at these levels in the market, I want to do at least a same delta Iron Condor, because it has just a little bit, it's at least closer to neutral. I want to be a little bit short deltas against the short Vega. Now, question says, with VIX this low, why not opt for a 45-day calendar? I'm not opting for anything. I mean, but you know, I'm not picking a Iron Condor over a calendar, right? I'm not doing that. But again, it's not that a calendar, right? It's not that a calendar is necessarily better than an Iron Condor or a VIX of 14, right? I mean, ultimately it comes out to how do you trade it. I definitely am looking at more calendars right now with the VIX at 14. But the point here is, when we're starting out the trade, we have almost double the room on the downside. And what do you mean you have double the room on the downside? My short strike is 1910. That's approximately 150 points away from the current price. My short call is 2150, only 85 points. I've got about twice the room. You see that? Yes or no? So structuring this trade up, yeah, I mean, if we go down a lot, I can get hurt if I do nothing. But the key here is, with SPX at these higher levels, the rally we've had, I definitely want to, as I'm structuring this trade, be a little bit short delta against my short Vega, right? And this trade will do it. The other thing is with the VIX at 14, you know, I'm just showing you a 45-day trade here. With the VIX at 14, would I want to be a little bit shorter duration or farther out duration? What do you think? With the VIX at 14, would I rather be a little bit shorter duration or longer duration? I'd rather be shorter duration, right? Question says, would you do something to offset your Vega exposure with being higher on the SPX? Well, let me ask you a question. Am I doing something to offset my Vega exposure? Am I doing something? Am I, the way I'm structuring this Iron Condor, am I offsetting it a bit? The answer is yes. Let me say it again one more time in Spanish. This will be a little bit of Spanish, but different than the Spanish from Mexico. This will be kind of the Spanish from Spain, all right? You ready? I've got 155 points on the downside, right? Before I hit my short strike, 85 on the upside. Now, yes, if I wanted more protection, could I buy an out-of-the-money put or something? Yeah, yeah. Would that cover me for a black swan? Yes. A blue swan? Yes. The end of the world? Yes. Twice the end of the world? Yes. 3 times the end of the world? Yeah. I could do all that, right? If I was, and that's an individual thing, right? If you think the world's going to end and you want, you know, you're looking for, if you put a May trade on and you're looking for a 10% move in the market and you want to get a little more insurance, sure, you can buy an out-of-the-money, you know, cheap out-of-the-money put against this trade. Absolutely. So that's the nice thing with options, whatever your concerns are. But I'd be comfortable starting out with this, right? But anyways, that's the point. Now, let's get into this a little bit. It's a $1.85 credit, $1.90. We'll just use a dollar. The mid is a $1.85 right now, but it's, let's just use a $1.90 credit. And a $1.90 credit, let's say we're using, let's find a 1 contract unit. What's my risk? John said the bid and ask is very wide. How do you get filled on this? Generally, what I found with, we trade a lot of SPX, generally you get filled within mid prices to the, you know, maybe 10 cents off the mid, which would be 1 penny in SPY. So execution is very good in here. So my risk is $810. I bring in a credit of $1.90. My risk is $810. So without getting into adjustments, let me just make this so it's clear with everybody here. The most important thing in the world of income trading, whether I'm doing Iron Condors or calendars or broken wing butterflies or quadruple butterflies or whatever the strategy is, just so you know, right? The most important thing is not the adjustment, right? The 2 most important things to be a successful income trader are consistency. If you're doing weeklies, you're trading it every week. If you're monthlies, you're trading every period. And I think that's the most important thing. And the second most important thing is, right, again, the 2 most important things, what I think I'm telling you to be successful. You know, I've been doing this for 15 years with retail traders, and it's still, you know, I mean, my thinking was the same at the beginning and the thinking same now, right? If the most successful traders are the guys doing it every week in SPX or RUT, or every month, whatever the time period. And you're ready for the second thing? And the beautiful thing is, even if you're a beginner out there, you can understand what I'm going to say next. When you lose, you don't lose more than maybe 1.5 to 2 times at the worst what you normally make in a good month. All right, so let's just assume here, right, just for ease of example, let's assume that if the credit's 190, and let's make an assumption that I want to make the whole $190 credit. I don't do it that way, but let's just start out with that thinking. So if I want to make a $190 credit, so I make my 190, what yield is that on my investment? If I make the whole credit, what yield is that on my investment? Anybody know? What yield is that on my investment? Say, Dan, what's your investment? Well, how much capital would I need to put up my brokerage firm for this trade? How much capital do I need to put up with my brokerage firm for this trade? Well, he knows, right, it's 1,000, but it's technically, isn't it? It's 1,000 less my credit, so it'd be $810, right? So if I'm making 190 divided by 810, it's like 23%, right? That's a lot for a month, and that means I got to wait till expiration. Right? And there's nothing wrong with doing something like that. I like to get out of the trade a little quicker, and I generally might go for maybe looking for like a 10% return, right? 10% return on my $800 or so might be $80, right? And that might be around 40% of the credit. That's more normal what we've been doing for the last 14, 15 years. Maybe going after, you know, and that's the way I've been trading for the last 15 years. We go for about 10%. But here's the key, right? Let me just tell you the key. I don't really care what you're going for, whether you're going for the whole credit, 50% of the credit, 40% of the credit, 60% of the credit. Here's what the whole ball of wax comes down to. Number one, are you playing consistently? Again, I don't care about your opinion. Play every month or every week, whatever duration. Number two is, when you're losing, you can't lose more than 1.5, 2 times at the most on a losing trade. In other words, your losing trades can't be that much over your winners. Very simple concept. And that includes any adjustments. So I'm not talking about adjustments today because I want you to understand that even if I add adjustments into it, it doesn't change the most I'm willing to lose, right? Adjustments really, the purpose of adjustments is to maybe delay a loss or give yourself more room for the position to work, right? But adjustments aren't the magic. The magic is, you know, if I asked a lot of you guys, how did you do in, you know, over the last year or last 2 years trading, whether it be Iron Condors or Calendars or Butterflies or whatever, some of you might say something like this. How many would you say, you know, Dan, I was doing good, but there were a couple months that just beat me up? Anybody says that? Anybody say that? Dan, you know, and here's the key, right? That's easily correctable, right? This is a numbers game. When you're down your max loss, to me, it's you get out, right? There's no, well, Fibonacci says this and Fibonacci says this, and I think it's going to come back. You know, I get it. I get it. None of us like to take losses, but this is a game, right? And you have to be very disciplined in cutting your losses and taking these stinking trades off. You hit that's really it. I mean, you know, the fundamentals of what makes a good Iron Condor trader have not changed in the last 25 years. I remember I did a video I don't know, 25 years ago on Iron Condors. I remember somebody like 4 or 5 years ago called me up and said, oh, yeah, thanks. I've actually been doing what you've been talking about. I've been doing well the last 10 years, right? And I think that the key is, the difficult thing, I would say only 20, in my opinion, from mentoring people for years and years, only about 20% of folk will be able to be successful at Iron. 20% of people will be really successful because 20% of the people will stick with something every month, put it on, and they'll get better at it. And those people will limit their losses. And the rest people, you know, I'm just telling you, it's just what I've seen. They're undisciplined. They don't play consistently. They're too directional. They put their opinion in there too much. I'm just saying, it's a basic trait, right? You know, there's a lot of adjustments we can do. There's a lot of adjustments we can talk about, but that's really not, the adjustments are not the most important thing. The most important thing is that you have a decent plan. You kind of know how to put the thing on. Someone said, is it better to leg into an Iron Condor? What does it mean, leg into? Leg into means you do the call side and the put side. You do the call side first and then the put side. You know, I would say your first 20 Iron Condors, put them all on at the same time. Why? Because unless you're really comfortable with SPX and you've been trading for a while and you know what you're doing, most people that are going to try to leg into it are going to look like three stooges, right? They'll sell the call spread and oops, the market will go up, and then they'll sell the put spread and now they're in worse prices. So my guideline is your first 20 Iron Condors that you do in SPX, just put them on. Then once you understand the vehicle and you're used to it, if you want to leg into it, go for it. Getting out of the trade, once I'm getting out, if I hit my profit target or my max loss, I may do one side first and then do the other, but I'm doing it within a 5-minute thing. I'm not doing it directionally or anything like that. So I just wanted today to talk a little bit about the simplicity of an Iron Condor, but a little bit I wanted to talk about with the market up at these levels, how I would structure the Iron Condor, right? If the market were, if SPX were at 1950, I would structure, maybe I'll talk another time, I would structure the Iron Condor differently, right? But again, the key is you don't, under any situation, want whatever you make in a good month for an Iron Condor. In a bad month, at the most, it can't be more than 2 times, right? Because you can't be losing, you know, you can't be making, you know, $1,000 3 months in a row and then the 4th month lose $5 grand. You know, it's not going to work, right? But those are the basic premises. And there's other ways you can, you know, there's a million other ways we could structure this, right? I could narrow the put side. Instead of doing a 10-wide put spread, if I'm concerned about the downside, I could narrow this spread a little bit. But, you know, how I'm talking about today, I think is fine, right? And all it means on this type of trade is I might get in a little trouble quicker on the upside than the downside. I don't mind adjusting a little quicker on the upside than the downside if I'm at 2066 in the SPX. In terms of execution, you know, you're generally going to get an SPX of 5 or 10 cents off the mid. So right, and again, the key is watch. Like right now, you can see it's $1.95 is the credit, right? And you know, but that moves that moves quite a bit, right? Oh yeah, right now it's $1.95 credit. Anyway, any other questions? I think I'll call it. Just wanted to talk a little bit about Iron Condor today. Anybody got any questions? Okay, so question says, isn't 11 delta a bit high to speak of high prob Iron Condor? No, the way I look at it, if I'm going 11 delta in the puts and 11 delta in the calls, it's about 22 total delta. 22 from 100 would be 78. So that's about a 78% probability of expiration that all the options will expire and you get your credit. So 78% to me is a pretty high probability. It's close to 80. Another question says, is there any better to choose 1895 strike with 3,174 volume instead of 1,900 with 537? Is it better? Okay. So is it better to choose certain strikes that maybe have higher open interest? No, you know what? Here's how I look at the whole open interest game. To me, if I'm in a vehicle that doesn't trade a lot of options, then low open interest bothers me. So let me ask you a question. Does SPX overall have good option liquidity? Does it trade a lot of options? SPX trades a ton. So as long as the underlying vehicle is very liquid, I don't care about the illiquidity in a certain strike, right? Or I don't care if there's low open interest if I'm in a liquid vehicle, right? If I'm trading SPX or Apple or something like that, I don't care if there's a strike that doesn't trade a lot because the vehicle is wonderful. The wings are so wide, how did you get it? The wings are only 10, the wings are 10, my longs are 10 points from my shorts. So it's not too wide. All right, any other questions? One thing I'd like to bring up while I'm waiting on some questions, just to let you know, June 16 and 17, if you want to put that down in your calendar, if you're not doing anything, we're going to have a wonderful two-day seminar in beautiful Chicago. We're going to have about 14 different excellent speakers, all very good craftsmen. Be a wonderful two-day seminar. I think for the price and what you get, it's the best option seminar of the year, bar none. I believe that. We've been doing it for about 7 years. In terms of practical information that you can use, I think the cost is about $400, and that includes some lunches and different things. But you get 14 different speakers over 2 weeks. We've got Tom Sosnoff. It's always very entertaining, very good, from Tasty Trade. Karen Bouton, super trader fame. So some people look at, she's just a great trader, manages a couple $100 million, maybe more, over at Thinkorswim. Russell Rhodes, volatility expert at the CBOE. Brian Overby from Trade King, and Jim Bittman from the CBOE will be speaking at credit spreads, brokers, hit brokers from some of the hits that we trade a lot of, like SPX. We'll have a lot of successful students from Sheridan Mentoring. I'll be speaking, some of the mentors. It should be a great 2 days. If you're interested, you can go to on our website and you can get some information on that. Another question says, how do you handle an overnight, a few questions here. How do you handle an overnight gap up or down in SPX that makes it impossible to limit your loss to 1.5, 2 times your credit? So the question says, how do you handle an overnight gap up or down in SPX that makes it impossible to limit your loss to 1.5 to 2 times your credit. So a couple thoughts here. You know, one way you can handle an overnight gap, if that was your concern, is you can buy out of the money put and call, and that can handle that. But the bigger issue is this. When the question says, how do you handle an overnight gap up or down in SPX that makes it impossible to limit your loss to 1.5, 2 times your credit? The question is this. Do you think there's been more than one move in the last 20 years that on an overnight, do you think there's been a move? Let me ask you a question. Do you think there's been a move over the last 20 years, an overnight gap, that I would have lost on a 40-day Iron Condor that I was near neutral the night before? Do you think in the last 20 years there's been a gap that I would have lost 1.5 to 2 times your credit? What do you think? In other words, what am I looking at? Do you really want to defend? How much do you want to spend on insurance? I don't think there's been something like that. So I think you have to be realistic. You know, again, this is a defined risk trade. If you're concerned about a gap, my guess is it'd probably be the downside. You know, if you want to go and spend 5% of your margin and buy an out of the money put, that'll settle it. But I think you have to be, you know, when you get, you know, you want to be careful how scared you get, right? Make sure it's realistic. All right, any other question? Let me just see here. Do I have any risk reward minimum for credit to receive compared to how much you will risk? You know, like here I'm getting a $1.90 credit for risk of 810. I don't really want to go, you know what? I would not go under myself personally $1 credit. So I wouldn't like bring in 70-cent credit, right, on a 10 wide Iron Condor to have risk of $930. You know, to me, it's not worth it. So, you know, I'm looking for around 8 to 10% expiration yields. So yes, I do look at the risk reward required. All right. If anybody has any other questions, I'll answer a few more. A couple other things, just to let you know, hot off the press, this Thursday ends a 3-week weekly class that I am completing this week. It'll be 3 weeks. Over 3 weeks, we met twice a week, approximately 1.5 hours each class. So you're talking 3 hours a week times 3, so about 9 to 10 hours of material. First time I did a weeklies seminar, and it'll be available to buy on archived as of Thursday. So that should be hot off the press if you're interested in that. Terry says, I find it hard to get a fill for SPX at the mid. How much less premium would you give away to get a fill? No more than 10 cents. Would I buy the insurance in a put or a call in the same expiration? If the expiration is 35 days from expiration, if I'm 35 days out or more on my Iron Condor, I would buy it in the same expiration. All right. And if there's any other questions that I missed, you can just send me an email. But anyways, I appreciate everybody coming in here today. Thank you so much. And we'll see you next webinar. Thank you.